Recently, the small and mid-cap segments of the mutual fund industry has been in the market news for a lot of reasons. Reports that there was a lot of froth. What is froth? We'll discuss a little later. And then the SEBI chairperson came and said that they will want all the mutual fund houses to do a stress test. Now that also we will discuss a little bit more in detail. But first up, what has the small and mid-cap segments done in the past few years? In the last 3 years, if you're an investor, either as a lump sum came in 3 years ago or did an SIP over the last 3 years in any small or mid-cap fund, you would have a very impressive double-digit return. The small caps would be anywhere in the 20s to 30s. The mid-caps will be either in the late 18 to 25 or 30%. So both these segments of the markets have given tremendous returns. Small caps, in fact, some of the fund investment values have doubled in the last 2.5 years or thereabouts. So it's been a tremendous asset creator for investors. But by the same definition, these small caps have a very low floating volume. What do I mean by floating volume? The overall market capitalization of small cap companies is very small, less than probably 10,000 crores, which means that it also suffers from a certain amount of liquidity. And being open-ended mutual funds, these mutual funds' mandate is when an investor submits a redemption, they need to be able to honor that redemption in 2 days' time. Now that's where the catch comes in, because as small caps, do they have the liquidity to provide, go sell in the market, create cash and give the money to the investor within 2 working days is the question that the securities chairperson was wanting to know. Now before we answer that, I want to go and ask, if you're an investor who has invested in these small and mid caps, you have 3 scenarios that can follow in the next few months. One is some amount of value can get corrected a bit, maybe 10%, maybe even 20%. You've got 100% value over the last 3 years. 20% correction is not necessarily bad. It's a good place to be. Provides a certain amount of consolidation within that segment, which is good for the overall growth of the market in the long term. So you could expect a little bit of consolidation and therefore a correction of about 10 to 20% in value terms. Second, you could find that given that there has been a tremendous interest and tremendous SIP flow into small caps, you could continue this race. It could get even more pricier. The value could continue to go up for some more time. Let's face it, there is a lot of liquidity now in the equity markets in the mutual fund space. Small investors have come in, they are here to stay, and they want the returns that these small cap funds have given. So there is a large amount of money coming into this segment as SIPs, and that is not going to stop in a hurry. So the valuation of SIP may continue to kind of inch upwards. Thereby, you may continue to see better returns in the next few months as well. And the third scenario is that the valuation may not change, given that there is a certain amount of new money coming in, there's a certain amount of profit booking investors are taking out. The small cap funds will more or less remain where they are. It'll be what we call a time correction. The value doesn't change over the next 2 years, means that the time has corrected in itself. So there are 3 scenarios. Now, based on these scenarios, as an investor, one of the questions that I get commonly asked is, what should I be doing? First, if you have a need for that money which is parked in small and mid cap, or a part of that money, in the next 18 months or so, you should exit to the extent of the money needed. Keep that money out of small and mid cap space. That's the smartest thing to do. Now, if you are chasing a long-term goal, say you are going to retire in another 10 years, 15 years, 20 years, just don't bother. Just stay in the space, go with the flow, be that surf rider. You know, when the wave goes down, you go with it, and when the wave comes back, you will come back, and it will come back. It's just that markets will remain volatile and there's nothing we can do about it. So ride the wave. You don't need the money tomorrow. You still have a longer time. As long as your time horizon is 5 years, 7 years and beyond, just stay put, don't bother, continue your SIPs. Third scenario if you are somebody who has invested with a certain profit booking motive, I think you should take the profit off today and leave the principal remaining in the fund. These are the three scenarios that's possible for any of the investors. And I'd urge you to look at all your existing portfolios of small and mid caps and see what one needs to do in this. Having said that, I've yet to address what is that word froth mean. If you're a South Indian filter coffee drinker, you would know that the filter coffee comes in a tumbler and what we call a davara, right? And it's kind of thrown up in the air so that it cools down and it mixes to bring a better flavor of the coffee. Now, when you do these actions, at the end of it, when you keep the tumbler, you would find a small increase in volume, which is not necessarily liquid, it's semi-liquid, semi-gas kind of a mixture. And that's what froth is. It is no value and it will disappear in no time. And eventually, if you let that drink cool, this froth will go away. The same thing is what is suspected to happen in the small cap. A lot of small cap stocks have gone beyond the right value for them. So eventually, the answer to that is to participate less in that particular segment of the market and let it cool down so that valuations are more appropriate. This doesn't happen naturally. One has to kind of play to that, and hopefully over a period of time this will happen for all of the market. That's the view. The second is, like I mentioned, what is stress test? We know stress is when we do something that is not within the spirit of what we want to do. We as human beings have stress only when there is something that I need to do which I don't want to naturally do. That's when stress comes. In the investment world, especially in small caps, when one is trying to exit the portfolio, the number of days it takes to kind of exit the portfolio is what is referred to as a stress test. For small cap and mid cap, these stress tests are extremely important because they help one determine how liquid their portfolio is. Always remember, like the Abhimanyu factor, it's not investing that matters. It's getting the money back. That's when the transaction closes. It's only halfway when you invest. The other half is when you exit the money. That exit of money is where the stress test plays a big role. For instance, all the larger funds which have small caps, like say Nippon or SBI, their stress test to liquidate about 50% of the portfolio almost goes to about 30 days, which means that they cannot adhere if all the investors technically come, 50% of the investors come technically on one day and want to redeem their portfolio, the fund will take 30 days to give your money back. That's really the reason of the stress test. And it puts in perspective that the small caps, while have given great returns, are also very illiquid. And it's important as investors we understand this. SEBI obviously is going to take this data and come back with a few points that is meant to protect the small investor. So we're waiting for that. But before SEBI comes up with some format of order, I think it's important that you and I understand that mid and small caps are going to be volatile at least in the next few months. So if there is some money that you want to take off the table at this point in time, may not be a bad idea.